pullback, correction, bear market, recession. These are the keywords we keep hearing every day these days as the stock market and its major indices had a double-digit negative start to the year. In this video, I'll describe these terms in simple language so we can understand them once and for all. Then we'll review how the three major stock market indices been doing so far this year and assess whether we are heading towards a recession. Lastly, we'll review my own stock portfolio and see how it's doing. Let's get into it. Stocks usually pull back about 5%, roughly 3 or 4 times per year. A pullback is defined as a decline between 5% and less than 10%. Last year, for instance, we saw roughly 3 pullbacks for the Dow and the S&P 500. All of that while the market actually went up 18.7% for the Dow and 26.9% for S&P 500 last year. What's more, stocks usually correct about 10% on average about once a year. A decline of between 10 to less than 20% is called a correction. We saw a correction with NASDAQ last year. Though it's worthwhile mentioning, NASDAQ ended up finishing the year in 2021 up 21.4% by the end of the year. When it comes to bear market in the stock market, it is referring to a decline of 20% or more. Those happen about once every 4.5 to 5 years. Based on these definitions, we see that currently NASDAQ is at a bear market, down almost 31% to date in 2022. S&P 500 is also in a bear market as it's down almost 23% year to date. As for the Dow Jones Index, it is down by almost 18% and is currently in the correction territory. When it comes to recession, it refers to an economic downturn that lasts months and even sometimes years. According to Forbes, experts declare a recession when a nation's economy experiences negative gross domestic product (GDP), rising levels of unemployment, falling retail sales, and contracting measures of income and manufacturing for an extended period of time. During a recession, the economy struggles. People lose work, companies make fewer sales, and the country's overall economic output declines. In 1974, economist Julius Shiskin came up with a few rules of thumb to define a recession. The most popular was 2 consecutive quarters of declining GDP. A healthy economy expands over time. So 2 quarters in a row of declining output suggests there are serious underlying problems, according to Shiskin. The definition of a recession became a common standard over the years, though it is worthwhile mentioning that it has its own limitation. For instance, it failed in the 2001 recession. At the time and until July of 2002, data showed just 1 down quarter of GDP, leading policymakers to claim there had been no recession. Yet later that month, revisions showed GDP down for 3 straight quarters. Complicating matters further, with the benefit of time, now we know that GDP actually zigzagged between negative and positive readings during those times, never showing 2 negative quarters in a row. But the far more important issue in 2001 was the loss of 2.7 million jobs, more than in any post-war recession. This indicates that you cannot rely on GDP as the sole indicator of a recession, and you need to take a more of a holistic look into things and consider other important factors as well. It is also worthwhile mentioning that the National Bureau of Economic Research, NBER, defines recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. The committee's view is that while each of the 3 criteria, depth, diffusion, and duration, needs to be met individually to some degree, extreme conditions revealed by one criterion may partially offset weaker indicators from another. For example, in the case of the February 2020 peak in economic activity, the National Bureau of Economic Research concluded that the drop in activity had been so great and so widely diffused throughout the economy that the downturn should be classified as a recession, even if it proved to be quite brief. Looking at where the stock market is currently at and how the market has reacted to the latest raising of interest by the Fed, it appears that the market and traders have already concluded that the recession is in the horizon. The GDP in Q1 was down 1.5%, and with the latest GDP now forecasted by the Federal Reserve Bank of Atlanta estimating that Q2 of GDP will be flat at 0%, which is down from the roughly 2% estimate just short while ago, it could be indications of a recession based on a definition of 2 quarters in a row of negative or declining GDP. In the meantime, it is worth mentioning that the Fed in US is estimating that the economy will advance throughout the rest of the year, putting full year GDP at 1.7% by year end, and then 1.7% again in 2023. So the Fed is not expecting a recession and is still forecasting growth, but the market seems to be discounting that forecast. Given the steep declines we have seen in the stock market, it seems the market is already pricing the worst case scenario of a recession. But whether that actually comes true remains to be seen. Perhaps a wise approach in this current environment in the stock market would be establishing a strong watch list of stocks that you intend to own and add them to your watch list and keep a close eye on them. In the meantime, you might be able to take advantage of the lower valuation for these high quality stocks and gradually add them to your portfolio. But perhaps it would be wise not to put all your money in the stock market right away, as nobody has a magic ball to know exactly what's going to happen in the stock market. While you can't perhaps wait and you want to take advantage of that, maybe you want to do it gradually in different intervals so that you're not going to kick yourself in the foot if suddenly the stock market starts to go up or down or any direction, depending on how it's going to pan out. All right, looking at our portfolio with Questrade, this is our Smith Manoeuvre portfolio. We are currently looking at a balance of 69,000, definitely down huge compared to a while ago. Currently, we are showing to be down by close to 15%, or we're in a negative about $13,000. We have two sets of holdings in this portfolio. This consists of 2,238 shares of Vanguard, and this is VEQT, Vanguard Investments Canada, fully giving us exposure to the equity market, the stock market, 100% exposure to stocks, which has not been performing that well. In fact, the 1-year return for VEQT is down by 11%. 6 months return is down by 16%. 3 months return is showing to be also down by close to 13.5%. 1 month's return is showing to be down by almost 5.5%. And the past week alone, this VEQT was down by 3%. As for us, as I indicated, we are looking at almost 16% negative return here. We have been adding to our existing shares of XDIV. It's a newer addition to our portfolio. Here is iShares Core MSCI Canadian Quality Units. Gives you exposure to high quality dividend paying Canadian stocks. It is currently down for us by about 6%, but we have only 14 shares here. If you look at the past performance of the XDIV, last week was almost down by 3.5%. The past 1 month is showing to be down by 6.5%. And the 3 months return is almost down by 12%. As for its 6 months return, we are looking at almost negative 3%. And 1 year return is still barely as positive at almost 1% positive. Definitely some attractive valuation for the most part, comparing to at least about a year or several past months ago. For those investors who are interested in this. As for our portfolio with Wealthsimple Trade, we're currently looking at a balance of close to $18,000, $17,500. This is mainly based on our investments in our non-registered account, whereby we have 8 positions. We have then tax-free savings account with 17 different holdings and our registered retirement savings plan with 10 positions. Looking at our recent buys in the past week, you'll notice here we've bought shares of Bank of Nova Scotia through fractional buy shares. We bought fractional shares of Bank of Montreal. We also bought shares of Manulife, Royal Bank of Canada, and Toronto Dominion Bank. We also added to our shares of PDI, Shopify, XDIV, and XEQT. Those are some of our recent buys in the stock market in the past week or so. If you look at the recent dividend income, in the meantime, let's see how things are showing up. Our latest dividend income here for our portfolio includes distributions of dividends received from the AX.UN, DGS, Skyworks Solutions, VDY, and CARS. These are our dividends mainly from the beginning of the month of June, as you noticed it here on the screen. What are your thoughts? Do you think we are heading towards a recession? Let me know your thoughts in the comment section down below. As always, if you enjoyed this video and gained something of value from it, please don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in dividend stocks, growth stocks, penny stocks. We also talk about ways to reach financial freedom. Thank you, and I hope to see you next time.